I have to come right flat out and tell you everything. Give me some money. Give me some money.
Whenever it's the IRS saying, give me some money, you know you'd better listen to it. But no one wants their tax obligations to sabotage their retirement goals when it comes time to take RMDs, required minimum distributions. But you know, it can happen unless you know how to prepare. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. I'm David Scranton. You know, we frequently discuss this topic of required minimum distributions, again, also known as RMDs, on the show. But having a plan for satisfying your RMDs without eating away at your savings is one of the single most important parts of a sound retirement strategy. And yet, not having such a plan is one of the most common financial mistakes that retirees make. One reason is that people tend to think of RMDs as an issue that they can always push off till tomorrow. However, tomorrow comes a lot sooner than we often expect. RMDs start at age 70 and a half, just 5 years or less into retirement for most individuals. That's when the IRS says, give me some money, and forces you to pay taxes on what was a tax-deferred retirement plan. Lack of proper education tends to be the main reason that people actually make these mistakes and mismanage their RMDs. We're going to fix all that today, and we're to give you a heads up about some big changes that may be in store for RMDs over the next few years. Joining me will be author, speaker, television host, and IRA expert, Mr. Ed Slott.
Because most people think it's the only option. If you watch the TV commercials and you call one of these big fund companies, they answer the phone, roll it over, hello, they like it's the only option because that benefits the place who's getting your money.
Along with Brad Williams, the president of Brad Williams Financial Services in Huntsville, Alabama.
Most people don't even think of the fact that you go from the accumulation stage of your life to the distribution stage, and the strategies are different. So they've never had anybody say that. Their Wall Street oriented broker maybe is all growth oriented and never really talked about that.
But first, let's take a crash course in RMD basics, RMDs 101. As the old saying goes, there's no such thing as a free lunch. And that expression applies to your retirement accounts as much as it does everything else. Yes, the government wants you to save for retirement, and it does give you financial incentive to do so. How? It allows you to put aside money for retirement in certain types of accounts without taxing it. But here's the catch. It isn't really tax-free. It's only tax-deferred, and the deferment ends when it comes time to take your required minimum distributions. That's when you'll have to start taking a certain amount of money out of your accounts each and every year, and thus paying income taxes on it. But the question becomes, when exactly is that? Well, the current rules we mentioned before is that you must start taking RMDs in the year in which you turn age 70 and a half. So for example, if you turn age 70 by June 30th of this year, then you must take a distribution sometime this year. But if you don't turn 70 until after July 1st, then you get to wait until next year. Why? Because you won't be 70 and a half until January of 2020. So technically the rule, though, is that you must take these distributions by the April 1st of the year following the year in which you turn 70 and a half. But in the real world, most people don't wait until that following year. Why? Because if they do so, then they end up having to take two distributions in 1 year. In other words, that's why most people take their first RMD literally in the year in which they turn 70 and a half, and then have to take one every single year thereafter. Now, there is an exception for people still employed at age 70 and a half, as long as they're not working for a business which they own. If that's your situation, then you do not have to take RMDs on your company's retirement plan. although you do still have to take them on any other qualified accounts. So, how much will your distributions be? To start, your required minimum distribution equals approximately 3.7% of your total IRA, 401k, and general qualified money balance. And then it increases every year as you get older and your life expectancy gets shorter. So as you get closer to life expectancy, the percentage increases. You can calculate the increase for yourself by using IRS Pub 590, which gives you a uniform table with a government-assumed life expectancy for each age, starting at age 70 and afterward. Simply take the balance of your IRAs on December 31st of the previous year and divide it by this life expectancy assumed figure. It sounds fairly simple, but there might be complications depending upon your personal situation. For example, a separate formula actually exists for IRA owners whose spouses are more than 10 years younger, and usually their RMDs end up being less. It's also important to keep in mind that if you have IRAs and any qualified plans, like a 401k, a 403b, or a 457 deferred comp plan, the RMDs from the IRA and each of these other plans must be calculated and withdrawn separately. They cannot be commingled. This is one of the main reasons most people roll over their qualified plans into IRAs before they turn age 70 and a half. It makes life simpler. Here's the bottom line. It's enormously important to do your RMD calculations correctly. Why? Because the penalty for not taking sufficient distributions is a whopping 50%. So now that you know when your RMDs start and how much they'll be, the question becomes how much tax will you have to pay on those RMDs? The answer is that the amount of extra tax liability you have because of these withdrawals depends upon many factors surrounding your individual situation. One of the keys to figuring out what you'll owe is to understand the concept called your marginal tax bracket. This is not the average of all your brackets, but it's actually the top tax bracket that you're in. But there are many other factors to consider in addition to marginal tax bracket when it comes to minimizing the burden from RMDs. One, for example, is taxes on Social Security. Every extra dollar of taxable income generated from any source, including RMDs, might just cause a greater part of your Social Security benefits to be taxed. This is where your RMD calculation gets really tricky. Why? Because it turns into some sort of perpetual loop calculation that can change each and every year. Here's the bottom line. Whatever that situation may be, by far and away the most important thing for you to consider when it comes to RMDs is whether or not you have the right asset allocation to satisfy the RMDs, as we'll be discussing in just a moment. And now it's time to bring in our first guest, Ed Slott. Ed is an author, speaker, and a television host. He's been called the best source for IRA advice by the Wall Street Journal and America's IRA expert by Mutual Funds magazine. And we're excited to have Ed back on the show here on The Income Generation. Thanks again for joining us.
Great to be here, Dave.
So first of all, since you follow this stuff much more closely than I do, or frankly almost any other financial advisor out there, do we have anything new coming up in terms of legislation that's been passed that's going to be impacting IRAs in the next year or so, or things that you think are on the brink that might be going to Congress that affect IRAs? Talk to us about that.
Well, there are some things in the works, and I have a feeling, I hate to I have to give you a Yogi Berra quote because, he said, I hate to make predictions, especially about the future.
Yes.
That's how I feel with tax law. Like they could have it wrapped up with a bow on it, and then somebody does something at the last minute. But here are some of the things they're talking about. They're talking about allowing you to make IRA contributions past 70 and a half. Right now, you can't do that. And that kind of makes sense. A lot of people are working well into their 70s, but there's this arcane rule that says for an IRA contribution, once you're 70 and a half, you can no longer contribute. While with a Roth IRA, there is no age restriction. So I think that's something that will pass and allow more older workers to keep contributing, which is important given today's life expectancy. There's also a rule to set the date for those RMDs, required minimum distributions, that most people can't stand. This is when you're 70 and a half and the money has to start going the other way and come out. So they have this 70 and a half rule. Nobody knows where this came from. My idea, and this is probably close to the truth, 2 congressmen in a bar One says 70, one says 71. They roll down the hill. Somehow it was 70 and a half for years and years. So finally, and this confuses a lot of seniors, the half year. Am I 70? Am I 71? So they're thinking of getting rid of that and just making it age 72. I think that's a good change and will simplify things for people. They're also thinking about toying with the post-death distributions. People call that the stretch IRA. When you die and leave an IRA to beneficiaries, right now some beneficiaries can go out 40, 50, 80 years, depending on their age. They're thinking of cutting that down to 10 or even 5 years. I don't know about that one. I think that's going to create too much complexity and make it too much to manage.
Well, it's going to increase increase the government's tax revenues, which is probably one of their motives in doing so, right?
Yeah, but it really won't. What they don't understand is how people work, act in real life. They look at numbers. They say, look at all these beneficiaries, young beneficiaries. They're going to stretch it out for 50 years. In the real world, most beneficiaries don't stretch it out. They have that money. They take that money out on the way to the funeral before the body's cold for the most part. That money goes out fast. So they're counting on money that is coming in anyway, because most beneficiaries don't wait 5 or even 10 years. They want to get their hands on the money. They don't even care about the taxes. You know why? Because they didn't earn that money. It's not their money. It's like gravy to them. So whatever they have left after taxes, they're fine with that. So I don't think this is a revenue raiser, and it'll cause more complexity.
It's like winning the lottery to a lot of people who inherit the money. Absolutely correct. So in the 1 minute we have left, I want to talk about the 50% penalty. A lot of advisors use this as a scare tactic. I even at least mentioned it on the show, but most people don't end up paying that 50% penalty, even if they make a mistake, from what I understand. Is that correct?
Yeah, that's a 50. Just to be clear, that's 50% penalty for not taking a required minimum distribution. 50% of the amount you have taken, but didn't. And people miss it all the time for a number of reasons. Remember, it applies generally to older people. People get sick, people die. So you just file a form. It's called 5329, and you make sure you make up the missed distribution. And IRS, in virtually every case that I've ever seen, has waived the penalty. But you have to ask. That's the key. You file that form 5329 with your tax return, and in almost every case they waive. I've never seen where it hasn't been waived.
Right. But so the point is, it's important, it's there, but don't let some advisor use it as a scare tactic in order to get your money. So Ed, we need to leave it there in this segment. And if you come back with us, we'll be back here in just a moment. We want you to stay with us also. We're here on The Income Generation. I'm David Scranton. We're here with Ed Slott. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Just like Ward and June Cleaver, I'm sure that your parents have given you some great advice over the years. And making sure your retirement savings is allocated properly for these pesky RMDs is really just a matter of following their advice. And that is, live off your interest and don't touch your principal. Now that sounds simple enough, but there are a lot of factors to consider in order to ensure that the interest and dividends being generated by your IRAs and your qualified accounts is enough to cover your RMDs and to satisfy all of your other retirement income needs. You see, ideally, an asset allocation right for taking RMD should be able to generate at least 3.7% interest or dividends. Now, we're not talking total return, we're talking about the interest and dividend component. Why? Because if you're earning less than 3.7% annually, then you could end up having to sell more shares of your mutual fund each year to satisfy your RMDs. In fact, this is one of the most common and potentially disastrous mistakes retirees make with their money, and I call it reverse dollar cost averaging. You see, regular dollar cost averaging is a strategy which involves spreading out your stock or your fund purchases, buying at regular intervals in roughly equal amounts. The idea is in doing so, you get your average cost or your average purchase price down. What does it do? It helps you essentially buy low, which is a cornerstone of smart investing. Here's an example. If you want to invest $100 a month in a mutual fund, and the first month the fund was worth $10 a share, you're now buying 10 shares. But let's say instead that the market now has a horrible month. In month 2, each share of the fund is only worth $5 a share. Well, if you stick with your plan, and I hope you would, then you'd now have to buy 20 shares to get $100 worth. After the second month, your average cost per share would at first seem to be $7.50, but it would actually be lower than that. Why? Because you bought twice as many shares at $5 and half as many shares at $10. So through dollar cost averaging, you're able to get your average cost per share down to $6.67. Now, this strategy can work well when you're in the growth and accumulation stage of retirement investing and putting money into a fund every single month. But the trouble occurs when you're no longer saving for retirement and if you start withdrawing from it periodically to take income or to satisfy these required minimum distributions. You see, when that happens, the same principle applies with dollar cost averaging, but it all happens in reverse. So taking the same example, let's say that in the first month you liquidate 100 shares and therefore you sell 10 shares because it's worth $10 a share. In the second month, the same thing happens, but now your fund's price per share has dropped down to $5 a share. So now in order to get your $100 withdrawal that the government's forcing you to take, you now have to sell 20 shares, twice as many shares. So now what's your average sales price per share? Well, you guessed it, the math is exactly the same. It may appear to be $7.50, but it's actually $6.65. But instead of taking your purchase price and pushing it down, essentially helping you buy low, instead what it's done is you push down your sales price. And remember, you want to buy low, but you really want to sell high. Unfortunately, in this case, the IRS has forced you to sell low. And RMDs aren't the only factor that cause people to fall into this dangerous trap of reverse dollar cost averaging, but they're one of the most common. But regardless of the reason, the point is that taking any money from principal to meet your income needs once you reach retirement can be a very slippery slope. It can happen even if your plan is not to spend principal, but instead to rely on capital gains. Why? Because capital gains and growth in a portfolio built heavily on stocks and mutual funds isn't something that you can count on year after year. Sometimes you invest for appreciation and growth, but you end up getting depreciation and shrinkage instead. Now, there was less danger of that in the 1980s and 90s when we were in the midst of the best long-term secular bull market in U.S. history. Back then, investors could conceivably have satisfied their RMDs from capital gains. But since the year 2000, the opposite has been true. The stock market suffered two devastating corrections of over 50%, 50, since the turn of the century. And according to the lessons of market history, a third major market drop is on the brink that could be between 40 and 70%. So again, I believe it all comes back to that great advice your parents gave you, which is more relevant today than ever before. Spend your interest and protect your principal. But is it really possible to generate enough interest and dividends to satisfy your RMDs and all your other retirement income needs without relying on the stock market? Well, if you're a regular viewer of the show, then you know the answer is yes. But first, let's welcome back author, speaker, and television host Ed Slott. So what are some of the major reasons? And we've touched upon them in the show today, but what are some of the major reasons why people, when they typically retire, they typically roll those 401ks, roll those 403bs, roll those 457 deferred comp plans over into IRAs? What have you seen historically, tax and otherwise, to be the benefits in that for so many people?
Well, you have more control in an IRA, but I'm glad you brought that up because most people think it's the only option. If you watch the TV commercials and you call one of these big fund companies, they answer the phone, roll it over, hello, they like it's the only option because that benefits the place who's getting your money.
Sure.
And it is for the most part the better option. You have more control over your money. You can do whatever you want, more investment choices, and you're away from your ex-company. And remember, most companies don't want to deal with you once you're out of there. You're an ex-employee. The last thing they want is to have people spend time with you. when you're no longer producing for them. But there are other options. You could leave it in a company plan. Maybe you like the investments, maybe you like the creditor protection, you have company stock, or maybe you get a new job, you could go to a new company's plan, or you might want to convert it to a Roth IRA, or if your plan has an in-plan Roth 401k, you can do an in-plan Roth conversion, or you might even want a lump sum distribution. If you have highly appreciated company stock, there are huge tax benefits. Most people in that situation miss out on those benefits because they're told to roll it over to an IRA. So if that's you, for example, you work for IBM and you have a lot of IBM stock in your 401k and it's highly appreciated, you might be better off doing something called NUA, net unrealized appreciation. Big tax break you should ask an advisor about before you do a rollover, because if you do a rollover, that's it. The option's gone.
And it's too late, that's right. But something that applies to, you mentioned a minute ago, applies to a greater percentage of our income generation viewers, and that is the question of Roth conversion. Please talk to our viewers about what are the pros and cons of a Roth conversion. For what type of people do you think typically Roth conversions can benefit them versus what types of people do you think maybe Roth conversions are not so beneficial? I know you can't paint anybody with a broad brush, but if you had to give some generalities, what would they be?
Well, personally, I have bias. I'm a big Roth IRA fan. And the reason is I like the idea of Roth income, which is tax-free. I like the idea of a tax-free retirement. Now, you have to pay money to get there. To move from an IRA to a Roth, you pay the tax up front, which most people can't stand. But if you look at the long-term big picture, at the end of the movie, you're sitting in a tax-free retirement. Now, that's a big hedge against the likelihood of higher future tax rates. Now, the idea is that you're going to be in a 0% tax bracket. So some people say, well, why should I do a Roth? I'll be in a lower tax bracket in retirement anyway when I pull the money out. Well, it won't be lower than zero. So that's my take on that. I mean, there's a lot of moving parts there, but you have to have the money to do it. You have to be able to write that check. Some people like the idea, they just can't write the check.
Yeah, and in the minute we have left in this segment, the new tax law, the Trump tax plan, has actually increased the benefits of Roth conversions. Has it not?
Well, you know what? It actually made it a little tougher because one of the things, and this was a big surprise on this year's returns, in one way it decreased the cost because of lower tax rates. And some business owners actually saw a big decrease because of that 20% deduction for business income. Some, not all. But if you're thinking about a Roth conversion, you first have to do an accurate projection. Because one of the things that people found out this year, I mean, we've been talking about it since it came out, but that was kind of inside baseball. But when they saw their returns and they said, this is how much I owe for the Roth conversion, it's irrevocable. You can't go back like you used to be able to do. So it's a permanent decision. So just make sure you know what the cost is going to be before you go all in.
Now, I see your point. It has made it a little bit more difficult. The good news, though, is most people don't realize that taxpayers today, married, filing jointly, making $100,000 are only in the 12% bracket. That's about as good as it gets around the world. So we need to take a commercial break right now. Stay with us. We'll be right back with many more words of wisdom, I'm sure, from our good friend Ed Slott. Now, recently we've discussed some possible changes to Social Security. These are bipartisan proposals meant to better ensure the program's long-term solvency and reduce the likelihood that future recipients will end up being forced to receive only partial benefits. Now, one of the major challenges facing the government when it comes to Social Security is also a challenge where RMDs come in, and that is increasing rates of longevity. Now, naturally, the government wants people to be financially self-sufficient during retirement. That's why it lets you grow your retirement savings without taxing it for a long time. But at the same time, the government doesn't want to wait until after you die to collect taxes. Why? Because with today's life expectancy rates increasing, it can end up having to wait a very, very long time. Longevity actually creates challenges for individuals as well. The overall challenge, of course, is that people today must create a plan to meet their income needs for up to 30 years or more. And with RMDs kicking in at age 70 and a half and increasing over all that time after 70 and a half, the longer you live, the more burdensome these can become. Now, to the government's credit, it has recognized this challenge, and it's actually lowered RMD percentage amounts in recent years. This has actually eased the burden a bit for many people, and now there's talk about other additional changes that could ease the burden of RMDs even further. In fact, on March 29th, the House Ways and Means Committee unveiled a new bipartisan bill called the SECURE Act. SECURE is an acronym for Setting Every Community Up for Retirement Enhancement. Then on April 1st, the Senate introduced a companion bipartisan bill called the Retirement Enhancement and Savings Act, or RESA. Together, these two pieces of legislation propose a host of changes to current laws and current guidelines around retirement savings. One calls for upping the starting age for required minimum distributions from 70 and a half to age 72. The change would give retirees more discretion in when to take their first RMD and also give them a significant amount of additional time to grow their savings tax-free. Both bills actually include proposals for allowing individuals with earned income to continue making contributions to additional IRAs, to traditional IRAs, after age 70 and a half. Right now, that's currently allowed only for Roth IRAs. Specifically, the current law actually allows married couples with earned income of $15,000 to contribute up to $14,000 a year to a Roth IRA, even if only one of them is still working. If the proposed changes are passed, they could also contribute to a traditional IRA and potentially deduct their contributions. Both of these proposed changes are based partly on the fact that, in addition to living longer, many people are also working longer, whether it's by choice or by necessity. In fact, a recent survey of 7,000 retirees and pre-retirees found that 47% of them have worked or plan to work during retirement. And of those, 72% say that they wanted to keep working. Now that's great, but there are also some potential hidden dangers in this trend that you need to consider. One is that people working longer may delay or neglect making an important shift in their financial strategy. And that is that also important shift we talk about all the time, from portfolio growth to income, from accumulation stage to a distribution stage. Now, if you're a regular viewer, you know I believe that the shift is the first critical step toward improving your odds of meeting your retirement goals, especially in today's incredibly uncertain market. Another potential danger is that continuing to work can actually be financially counterproductive for some people in certain situations. You know, there are expenses associated with working that actually go away once you retire. And if you're starting a new business after retirement and spending capital from your own pocket to do it, obviously that can be a risky venture as well. Here's the bottom line. No matter how long you continue to work, if you're within 10 years of retirement, the sooner you meet the right professional to start working on your retirement strategy, the better off you're likely to be. And as we've seen today, satisfying your RMDs with the minimal amount of tax burden possible and without the risk of spending down your principal can be a complex process. And that's not likely to change anytime soon, even if Congress does update the current laws. The process gets even more complex when you factor in all the other issues and challenges that need to be addressed. Inflation, healthcare inflation in particular, low interest rates today, historic levels of stock market volatility, Social Security, estate planning, and as mentioned, the need to prepare for up to 30 years or more of reliable retirement income. In other words, as I so often say, don't try this at home. Now it's time to welcome back for one last segment, author, speaker, television host, and friend of the income generation, Mr. Ed Slott. So we talked about our required minimum distributions, but you know, a lot of our viewers are over 70 and a half, but a lot of them are not. So let's just broaden it up for this last segment. And if you could share with our viewers, what are some of the opportunities in the IRA world that a lot of people are missing? And conversely, what are some of the most common mistakes maybe that people make with IRAs that they're just not aware of? Help us out.
Yeah, well, we just talked about Roth IRAs, the big fit with the lower tax rates, and you can push more through. But some people are gun shy because they know they can't go back. I would say maybe do a series of smaller annual conversions, or wait towards the end of the year when you have a better idea when your income is, what your income might be for the year. Maybe when you know how much of a bonus you might get or what might bump your bracket. But don't shy away from the Roth. I think it's a fantastic way to build
And just to be clear, Ed, you could do those at any age, correct? These Roth conversions.
You can convert from a 401k, from an IRA. Yeah, anyone can convert. There's income limit. I'm glad you brought that up. People still think there's an income limit. There was many, many years ago. That's been repealed for many years. Doesn't matter how much you make, you can convert. And actually, it can help other parts of the return. Here's another mistake we see all the time. I was going to say we saw this year. But when people take those required minimum distributions and they have, say, a 401k or an IRA, they think you can take them from any which way and mix and match. You can't. Your IRA RMD has to be taken from your IRA. You can't say, I'll take that from my 401k. Because when people do that, they have a problem. They took too much from one and not enough from another. Or we even see husband and wives get mixed up because they think logically. And the problem is the tax law is not logical. You have a husband and wife. They're both over 70 and a half. They both have IRAs and they both have RMD. So the husband might say, let's take it from yours. You have a little more. We'll even it out. Can't do that. The I in IRA stands for individual. You each have to take your own. Now, in the bottom line, if they take the right amount, it's the same tax. So they think, well, what's the difference where we take it from? It's a big difference because now one's short and one took too much.
Mm-hmm. Now, there are no income limits anymore for Roth conversions, but there are still income limits for people who want to make contributions, $5,000 or $6,000 a year, for example.
Yeah.
Is there an end around that is legal still that people can take?
Yes. I'm glad you brought that up because as a result of the new tax law, it didn't mention it specifically, but in the conference report, they okayed a strategy we kind of call a backdoor Roth conversion, where if you make too much to contribute to a Roth, you can instead contribute to a non-deductible additional IRA, then convert it to a Roth. Many tax people said, oh, no, that's a backdoor. You can't do that. There's no question. The congressional report said it's absolutely legal. And last year, IRS came out and said, we think so, too. We're not going to challenge it. So it's a great way to push $6,000 for 2019. And if you're 50 or over, that's $7,000. And if you're married, you could double that to $14,000 and you're 50 or over. So you can push a lot of money into Roth, even if you didn't otherwise qualify.
So if your bottom line is if your tax man said that is gray area, you got to update them and say, no, it's not gray area anymore. Ed, very enlightening as usual. Really appreciate you being on the show.
Thanks, David. Great to be here.
And we appreciate you watching, so stick around. We'll be right back here on The Income Generation. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Time does fly fast, my son. It seems only yesterday I ordered your first diaper changed.
Time flies when you're having fun, but the reality of it is it also flies even when you're not having fun. Let's face it, it just flies. That's why even if you're still in your mid-50s, age 70 and a half may feel like it's a long way off. But I can promise you it'll be here soon enough. And if you're lucky, you'll still feel like you do today in your 50s and be enjoying a happy, healthy retirement. Or still happily working if that's what you prefer. But either way, your odds of enjoying good financial health at that time will be improved. Improved if you made the right moves ahead of time to prepare for these RMDs. So what exactly are some of these moves? Well, it really all starts with making that paradigm shift from an investment strategy focused on growth to one focused on income and protection. Why? Because once you've done that, you're typically investing in things designed specifically to protect you from the risk of principal spend down and to generate income and dividends at competitive rates. So I can hear some of you now saying, But are those competitive rates really enough to meet my income needs and satisfy my RMDs? Because I've always heard the only way to really get the best return was to buy and hold in the stock market. Well, as always, I'm happy to dispel that myth, which is based on the misconception that growth and return are one and the same. They're not. As I often explain, total return on any investment is a sum of both growth as well as income, with growth coming in the form of capital appreciation and income coming in the form of interest and dividends. You see, when you're investing for capital appreciation, you not only run a greater risk of spending down your principal through that concept we called reverse dollar cost averaging, but you may also run a much greater risk of suffering a major loss when the market crashes. On the other hand, by investing specifically for interest and dividends, for income in other words, you're typically investing in contract-based strategies designed to protect your principal from volatility and from spend down. So exactly how do the two approaches compare? Well, since the turn of the century, the average annualized return for buy and hold stock market investors has only been about 5% a year, and that's with dividends factored in. By comparison, though, many income-based investors whose portfolios have been properly managed during the same period have achieved close to 5% just in the income component annually, and greater than a 5% average annualized rate of return. So again, return isn't just about growth. It's about growth and income. And once most investors understand that, they begin to see the logic in investing specifically for income rather than growth. They understand it's a practical strategy, not only for meeting their individual retirement goals, but for handling the many new financial challenges that emerge with retirement, including, yes, those pesky required minimum distributions. Now it's time to welcome our next guest, Brad Williams, the founder of Brad Williams Financial Services in Huntsville, Alabama. He has over 30 years of experience focusing on financial challenges that face retirees, near retirees, and business owners. Brad, thanks so much for being back on the show.
Oh, Dave, it's great to be back. Thanks for having me.
You're very welcome. And as being a friend of the income generation, not to mention a personal friend of yours truly, you know, you just heard Ed Slott talk about how complicated these RMD rules can be. Are they really that complex? Or for 99% of the population, is it simple? Or, you know, in your experience, are people really confused by these? I mean, talk to us about what you see with boots on the ground in Huntsville, Alabama.
Well, as I work with clients, initially they're all confused. They think it's complex, and what they're really looking for is somebody to hold their hand through the process, because there are different strategies you can use. You know, how do you take it from income? Do you take it from growth? Do you take it all out of one? Do you take it each equally out of, say 4 IRAs if you have 4 IRAs? So what I'm seeing is that people just want someone to coach them through the process, and then they feel a lot better about it.
So it sounds like from a planning perspective, you have a lot of tools that you utilize with your clients to be able to take advantage of RMDs, maybe to be able to take it out of certain accounts that may be lower yielding, or certain accounts that might have a huge gain built in, to be able to realize that, tax-free within the shelter of the IRA. Is that the type of planning that you like to do with people oftentimes?
Yes, it is. Let's say you have an account that this year is really performing stellar, and you have other accounts that are just mediocre in what they're in. Well, what I coach my folks is, let the good money run, and let's take it from the other accounts, and then we can take a look at another strategy next year. So I don't know if Ed mentioned, but there's even talk that I understand Congress passed a bill that would raise the RMD age to 72. That would be nice if it goes through.
That'd be nice, yeah. So most people, left to their own vices, 15 seconds are left in the segment if you can, just, they would take it pro rata from each account, correct? So what you do to help them strategize is kind of over and above that.
Exactly. They'd call their custodians and just say, hey, I need my RMD, and they'd get it, and there wouldn't be much thought in the process. And the key is maximizing what you have.
We need to take a break. We come back, though, we're going to ask you about the whole thing about taking it from gains or from principal or from interest or dividends. I want to get your feedback on that. And you stay with us also. We'll be right back with more from Brad Williams. This is David Scranton. You're watching The Income Generation. We'll be right back. Welcome back. We're talking with my good friend Brad Williams, founder of Brad Williams Financial Services in Huntsville, Alabama. Brad, thanks for sticking around.
Oh, great. No problem, Dave.
So we talked about whether these RMDs should be taken from interest, dividends, from principal, from capital gains. And you know, I've talked about it, as you heard earlier on the show. We always talk about it. You and I always talk about it behind the scenes. But you know, how many people really come to you realizing that, gosh, if they have any chance at all living to 90 and they're taking any principal at all at age 70, that they could run out of money? I mean, do people realize that intuitively on some gut level, or do many not really catch on to that?
Well, I think it's a fear they have. It's kind of like those people that you've probably encountered that show up at your office and they bring their statements and they haven't even opened the envelope and they got a stack of unopened envelopes. So I think that running out of money before they run out of life is one of those fears that they really don't want to talk about. And I think our job as advisors is to ask the hard questions, to get at the real answers. And that's where we come in and show them, how do you take the RMDs? What is the best way? So,
you know, you can easily show people that, gosh, if you're getting 2% in a CD inside an IRA and you have to take out 4, you know, half's coming from interest, half's coming from principal. By the time you're 90, you're going to have it spent down. But a lot of people think if they're in mutual funds or in the market, well, gains and income are the same. They could take it out of gains. But you and I know different. Do you find in the real world, talking to people with boots on the ground every day, that people really understand that when they're taking capital gains, they're essentially taking principal? Or do most people really don't understand that until you get to explain it to them succinctly?
I think they don't understand it until it's laid out for them. And most people don't even think of the fact that you go from the accumulation stage of your life to the distribution stage, and the strategies are different. So they've never had anybody say that. Their Wall Street oriented broker maybe is all growth oriented and never really talked about that. Maybe they don't even have income tools available to them. So showing them what I get is that flash of recognition in their eyes when you start talking about why they want to take their RMDs from the income and not the principal.
Yeah, I mean, if you say to somebody in that example, gosh, you're getting 2% dividend, you have to get 2% growth every year. You think you're going to get 2% growth each and every year? Well, they're going to say, no, of course not. So the question becomes, where does it come from in the years that you don't get the 2%? And
right.
The answer is principal. It's kind of as simple as that, isn't it?
Yes, it is. It is. And most people just don't think of it that way. They think of their IRA as one unit, and they need to take money out and they take it out. They don't think where it's coming from.
Yeah, and I guess part of the problem is you even have big financial companies out there saying it's about that number, how much you have the day of retirement. And they fail to realize it's not about that number, it's about the amount of income that number can generate. So Brad, thanks so much once again for being on the show. Really appreciate it.
Oh, no problem. Thank you, Dave, for having me.
We need to take a commercial break. Stick with us. We'll be right back here on The Income Generation. I'm David Scranton. I'd like to thank all of our guests for joining us today for another episode of The Income Generation. Most importantly, I'd like to thank you, our new and returning viewers. You know, as we mentioned at the top of the show, RMDs are a topic that we do discuss frequently, and with good reason, which I hope today's show has made clear. Not having the right plan for satisfying your RMDs once they kick in is one of the most common and costly mistakes that retirees make. In my experience, avoiding that mistake takes a well-planned strategy that first protects your principal. Second, minimize your tax burden from RMDs. And third, generates enough income from interest and dividends to satisfy those RMDs, as well as to meet all your other income needs and goals throughout retirement, without having to rely on capital gains. Now, as we saw, if you're relying on capital gains in the current market environment, it's really no different from spending down principal to pay your RMDs, which is a slippery slope you want to avoid. Your best chance of avoiding that slope is to work with a financial advisor who specializes in financial strategies geared toward protecting principal and generating income through interest and dividends. And if you're within 10 to 15 years of retirement, then the sooner you start, the better off you'll be. Age 70 and a half, when RMDs kick in, may seem like it's a long way off for some of you. But remember, time flies. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.